As we think about the landscape of investment opportunities, there's thousands of things out there.
Yep.
There's stocks, there's bonds, mutual funds, ETFs, cryptocurrency. There's an almost endless opportunity of where I can place my money, an endless opportunity of mixture of how I can place my money in those areas. However, they don't all suit my needs and my goals.
Right.
And they have different risks associated with them. So rather than diving into the minutia of what do I want to invest in right now, let's break it out a little bit into our two broad categories, equity and fixed income. So Spencer, you want to kind of dive in there and talk about those two broad categories for us?
Yeah, and this really comes back to that idea that Oliver Wendell Holmes, the Supreme Court Justice, went through, that is the idea of trying to find the simplicity that's on the far side of complexity to explain something. So we break it down into stocks and bonds, or equity and fixed income, as you said. And really the defining point of the equity is that you are an owner of company or real estate. You are a lender on the fixed income side. So you lend resources to a bank or to a company or to a government. You're lending those resources, you're paid interest there. Whereas on the other side, again, you're an owner of, be it the stock or real estate, or it could even be a commodity that's out there on the other side of that. Now, if we look at our goals, these align nicely as we think about our goals, because when we look at goals and how we invest to achieve those goals, the whole goal is that we are efficient. We want to be more efficient than stuffing money under the mattress there. So we've got to find an efficient way to meet future financial goals that are out there. And we want to think about our investments. Do I want to be an owner or a lender to be able to, again, move in that direction efficiently? If we look at our risks as investors, one of the risks is that things get more expensive over time. So there is inflation. If I'm trying to buy a car now or buy a car in 5 years, the nominal amount that I have to pay in 5 years is probably going to be higher than it is right now. So there's going to be some inflation there. The second risk that we face, of course, is if we make an investment, there's no guarantee that we're going to get those funds back, particularly if we invest in a company and we're an owner, or even if we just lend money to a company or to a lot of different institutions as a lender, there's no guarantee that we're going to get those funds back. So we, on the one hand, we've got to say one of our risks is, again, inflation. I've got to ideally get a rate of return that helps me keep up with or surpass what the cost is going to be in the future for that goal. The other side of things is I've got to grapple with how much the investment may go up or down in certain circumstances. And so again, as an owner of stocks or real estate, we have an opportunity for growth on one side of things. As a lender, maybe we have a little bit more security, not ultimate security that we know we're going to get the funds back, but a higher likelihood that we'll get those resources back over time.
So we got a visual we'll walk through to kind of sketch out that different equity and fixed income.
On the left side here, we'll draw fixed income, and on the right side, equity investments. Now, fixed income investments do a nice job of holding up when the economy turns south, when the stock market drops, generally speaking. The rate of return typically for fixed income investments is nice, slow and steady as she goes. You can see that there's some wiggles in there, but the ups and downs are not usually nearly anything like the stock market. Fixed income investments, again, do a nice job of helping us deal with the volatility of the stock market. At the same time, fixed income investments don't do a great job of helping us to offset inflation, to outpace inflation over a long period of time. They're not our growth engine. Equity investments, on the other side of things, are that growth engine. A rate of return in equities would be something akin to maybe that, where we have much steeper gains and losses at different times, but the rate of return over a long period of time is much more significantly moving upward. That's what history would suggest for us. So equity investments, being our growth engine, help us to outpace inflation over a long period of time. When we think about equity investments, though, they expose us to volatility. They expose us to those ups and downs. Whereas fixed income investments, they expose us sometimes to inflation. So as we think about this, we want to have enough in fixed income to help us deal with the volatility in the stock market. We want to have enough in the stock market in equity investments to help us deal with our need for long-term growth to offset inflation. So as we think about that, we do it for each client that comes, and we think about financial planning and what distributions might need to be. And where we try to arrive is at a different point with each client, so that we draw this dotted line based purely on the financial plan for a given client.
Well, thanks for sketching that out for us, Spencer. So what's next? What do we need to do next?
Yeah, so I think it's important first, again, to grasp the basics here.
Yeah.
As we get into this, we want to go one layer deeper, though, because this is about risk.
Yeah.
We have risk in inflation over time.
Right.
We also have risk in what investments do over time, the ups and downs that they may have. Mm-hmm. So we want to do a little bit deeper dive here that will be content that you can see related to how the stock market has gone up and down over time, and how the bond market has done the same thing. So we'll dive in there because we want you to have a sense of how often these episodes tend to happen, how deep the dive may be, what that risk really is, and how long the recovery takes from there. As we often say, Warren Buffett has 2 rules of investment. First rule is don't lose money. Second rule is don't forget the first rule. We kind of come back to that and say, if we can construct a plan where you're not selling out at a loss, where we can look at these different risks, and we know that investments are going to go up and down, but if we can sketch something where you're comfortable in the downturn and can wait it out, then you're in a much higher likelihood of having success than if you get to that downturn and you sell out at an inopportune time, lock in that loss, and don't participate then in the recovery.
Right. Well, great. We'll look forward to seeing you all again soon. This content was provided by Retirement Planning Services. We're in Knoxville, Tennessee, and you can visit our website at www.seriousretirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents.